Hello, this is Angus Murray from Castlestone Management. I wanted to present to you 9 slides taking a look at how equities perform as we head into an economic slowdown or recession. You can clearly see that although recovery times and strengths vary, there has been mostly an historic positive performance as we begin to understand that a recession is occurring and begin to come out of that recession. These are the main points we'd like to make. First of all, it is clear that the US economy is showing signs of slowing that will begin to contain inflation, but it does seem that a recession is a general consensus among economists. As I indicated, the recovery times and strengths vary with regard to equity markets, but most equity markets have had a positive performance once a recession starts, and you may even argue that that's already occurred. Third point is that investors' allocations to equities are at their lowest levels since October 2008. And this is rather normal in these periods, but actually it indicates that very clearly these are times to be allocating to equities and doing the opposite of what is generally occurring. And then lastly, that equities perform the worst 1 year before a recession. Again, I would indicate that that is probably already where we are if we are not past that point. Here is just an indication with regard to the number of people indicating that a recession is likely. It was pretty clear that a recession was likely in March of 2009, but of course that was the bottom of the equity market. The recession had clearly happened before that. If you take a look at April 2020, clearly again we end up with the fact that equity markets were clearly bottomed or had bottomed already at that point in time. That is obviously the recession associated with COVID. And again, we see that beginning to happen in July 2022. Hence the indications that there are clear signs that people should be allocating or increasing their allocations to equities now. This is an indication with regard to people taking risk, and you can clearly see that there has been a significant drop-off in the level of risk being taken in the market. So any excesses that we had previously have been removed from the market. If you combine that with historic numbers, it does indicate quite clearly that it is probably a good time to be increasing allocations to equities in general. If nothing else, it is certainly the worst time to be selling or allocating away from equities. This is the Federal Reserve controlling inflationary expectations. Clearly the Federal Reserve indicating that it is going to increase interest rates to head off inflation has had an effect both on the economy from a reality of rates being higher, but also from the sentiment that comes from it. The conclusion on this slide, though, is not necessarily that there is going to be a deep recession. That is not a foregone conclusion. In fact, the Federal Reserve has already indicated that it is highly aware of the need and the timing with regard to potentially cutting rates the moment that we see inflation under control. Although a little bit detailed, this does show you how stocks have tended to perform around recessions. And during the recession, which I would say we are already actually started to a degree, you can see that the number of positive periods through that time is quite high, just under 50%. But when you look out over the next 12 to 24 months, there is clearly a very strong indication that equities will be higher. In those cases, 2 years out, equities were higher 82% of the time. This is a chart we showed previously, and it just goes through to indicate again what happens after the S&P 500 falls 20% from its highs, with data going back to 1950. You can clearly see that in 89% of the cases, 3 years out, the S&P 500 is positive. But I think it's worth looking at that 2008 year, where clearly there were significant excesses in the economy in general. But after 6 months, the market having declined 27%, well, you're obviously declining now around 20, and out to 1 year, the market took time to recover. But within 2 years, it was already clearly beginning to recover. Our comments would be that the market is going to understand that this recession / economic slowdown is going to be mild or moderate. And in fact, people are going to begin to price in recovery much sooner than we expect. And that could clearly be over the next 3 months. Here, just taking a look at the drawdowns again, and then seeing what happens over the next 12 months in terms of performance. And our indication is that with equities having declined plus or minus 20%, that there is clearly upside to come over the next 12 months. I'd just indicate, therefore, if we take a look at the tech bubble, which was a break, but there were clear excesses with pets.com going from a valuation of 20 billion to zero, and the financial crisis where it took validly a period of time for the significant excesses to be wiped out and the banks to write off loans within portfolios. But the recovery that came in the next 12 months was quite pronounced. So I think it is certainly worth highlighting that and the history associated with the performance of equities. And then lastly, it's just taking a look at the theoretical performance of $10,000 invested when a US recession begins. You could argue, as we've indicated, that a US recession has already begun. And therefore, if you take a look at a period of 0 to 3 months or 0 to 6 months out, then there is clearly an indication that in most cases, the majority of the time, equities have already begun to price in that recovery. And the net result is people make a profit, particularly if you look out then over 24 months. So you can see appreciation of anywhere between 20 and 60%. If you'd like any further information on that, by all means, please contact our sales staff and we'd be happy to discuss it. Thank you.